Hi everyone, my name is Nikita Polishchuk. I'm the financial analyst at PHC Advisory Tax Accounting, part of DP Group. In today's video, I will talk about the annual audit in China for foreign invested enterprises. I will begin by introducing our company, DP Group. DP Group is led by its founding partners, Carl D'Andrea and Matteo Zhi, and DP Group incorporates 4 different companies. First is our international law firm, D'Andrea Partners Legal Counsel, which is made up of professionals coming from different countries around the world. The company headquarters located in Shanghai, and the D'Andrea Partners Legal Counsel has a number of branches around Asia, Europe, as well as a Russian desk. And the firm's clients include large industrial groups, as well as medium-sized Italian, Chinese, and global enterprises. Our practice areas include corporate and commercial law, legal compliance, environmental law, business intelligence reports, dispute resolutions, and many others. Secondly is our international consulting firm, PHC Advisory Tax and Accounting, which specializes in taxation, finance, and accounting. We provide services such as the back office support of accounting functions, tax compliance, treasury, payroll management. We also advise companies on their M&A and other extraordinary activities, as well as provide internal audit and financial supervision. Lastly, we provide business consulting on both corporate and personal levels. Eastern Communication and Events is our international agency which specializes in social media management, digital marketing, PR, and events planning. And Chance and Better Education provides such services as the short-term visits and senior courses, short-term internship, as well as language training and online education. We're also active in publishing China practical guides for investors which might be interested in entering the Chinese market. And these guides are available in English, Italian, and Russian versions in both printed and e-book formats. We also publish a number of international practical guides about the various aspects of investing in Vietnamese, Italian, and Belarusian markets. And these guides are also available in both printed and e-book formats. On this slide, you can see some of our clients. And these are the addresses of our offices worldwide. And so now back to the topic of today's video, annual audit in China for foreign invested enterprises. First, I begin by introducing several important concepts to understand what an annual audit is. Then I focus on some of the specifics of the annual audit in China, as well as discover the reasons behind the annual compliance check. Finally, I look at some of the more common mistakes that foreign invested enterprises in China often make, and then it provides some advice on how to actually avoid these mistakes in practice. So first, let's begin by introducing several important concepts to understand what an annual audit actually is. First of all, annual audit is an examination and evaluation of the company's financial statements by a qualified certified public accounting firm, CPA firm, in order to ensure that various stakeholders, in order to ensure them that the records are accurate, fair, and free from any material misstatement. Essentially, a company must prepare all its financial statements for the year, then hire a CPA firm, submit its records to a CPA firm, and then this CPA firm will do the examination and then issue its auditor conclusion. In practice, small companies in China don't need to undergo the annual audit, unlike the bigger multinational public companies. However, in the case of foreign companies or foreign investment enterprises, as they're also known, it's actually a legal requirement to undergo the annual audit and submit the report. So now let's look at what do actually annual audit, what does actual annual audit involve? First is the check of accounts. So the auditors will try to verify all the recorded transactions. In particular, they might focus on the accounts receivable and account payable sides, for example, verifying the amount and assessing the risk of any bad debts occurring, as well as ensuring that the estimated amounts are correct and reasonable. Then is the verification of capital. So the auditors will examine the bank accounts and to see whether this matches the accounting records and whether various cash ratios actually meet the requirements and the thresholds which are stated by the law. Auditors will also investigate whether the accounting records are consistent with the bank records. Then the verification of assets. Essentially, the auditors will investigate inventories and the fixed assets. They must ensure that these numbers are in line with the records in their accounting books. They will also check whether all the documentation and tax records are complete. Then the auditors will focus on the related party transactions. They will try to ensure and evaluate whether those were made on time and whether all the supporting documents are complete and available. And the auditors might also assess whether the transfer pricing rules are actually in line with the arm's length principle in order to avoid any potential tax adjustments, fines, or penalties. Then they will check the amount of expenses in order to ensure that all the relevant invoices, service agreements, and other documentation have been obtained and recorded. And they will also verify whether there exist all the supporting documents in order to ensure that these documents meet the threshold for certain deductible expenses to apply. The auditors will certainly focus on balance sheet and income statements in order to reveal all the structures, capital structures, profit and loss, expenses, and other items. And finally, companies during the year may actually apply to qualify for tax preferential policies themselves. However, the auditors at the end of the year will actually help to evaluate whether these relevant qualifications are met in their annual audit report. So now that we have established what goes into the annual audit in China, let's see several reasons for undergoing this audit. So as previously mentioned, it is in fact a legal requirement in China for all the foreign invested enterprises to undergo an annual audit. However, there are a few other reasons that might be important for the businesses in China. So the first one might be that this annual audit report for a Chinese company can be required by the overseas headquarters for the purposes of the consolidation. So if an overseas headquarters is required by law to complete this annual audit in its home country, the domestic subsidiary in China here must provide the annual audit report and ensure that certain elements in this report, including maybe revenues or assets, meet the threshold which are set by the overseas regulation. Annual audit is also actually a requirement for profit repatriation. Generally speaking, the foreign investor enterprise in China can repatriate profit only once a year and only after the annual audit and all the tax compliance processes are complete. And during this verification process, the authorities will actually use the annual audit to ensure that the business is compliant with all the local laws and regulations. And they will also check whether the corporate income tax, CIT, has been paid on time and fully on the profits which are reported in the financial statements. And finally, the authorities will actually then confirm to businesses the maximum amount of money, the maximum amount of profit that can be repatriated from the net profit of its Chinese business. And lastly, sometimes in the cases where tax or even customs authorities may initiate any investigation against the company, company may be required to provide several audit reports for period of time, for some period of time in the past. So now to some of the common mistakes that they now experience foreign investor enterprise make during their accounting processes during the year and the annual audit. So first would be the incorrect tax treatment. So basically misunderstanding the tax system and sometimes misunderstanding the tax system when it comes to the cross-border transactions especially. Next is the bookkeeping errors. So for example, not recording the revenues on time or categorizing expenses in the wrong category. And finally, it could be the incorrect treatment of foreign exchange activity. This is especially in relation to categorizing money that the company received from overseas in the wrong manner. So these kind of mistakes, in fact, can be rather costly, and indeed they may distort normal operational activities of companies in the future. Therefore, we would advise to have the adequate controls in place in advance in order to ensure the full compliance with the local laws and regulations. And so finally, how can actually foreign investment enterprises avoid these common mistakes? Yeah. So first of all, is of course to have a professional accounting team. In many cases, for small or even medium enterprises in China, foreign investment enterprise in China, it might be costly to have the full-scale accounting team in-house to support its operations. Thus, for them, it would actually be advisable to hire a professional accounting firm in order to support their back office activities. Secondly is, of course, to be aware of the most recent tax and compliance regulations. And similarly to the first point, it might be actually costly to have the full-scale legal team on board and monitor the updates and ensure the full compliance. Thus, once again, these kind of activities can be outsourced to some of the either law firms or other consulting firms. Next would be to start the annual audit at the right time. This is especially important for the bigger companies who might need to prepare a number of documentations, and they must ensure that all the documents are correct and available. Next would be, of course, to improve internal compliance and risk management. And lastly, for multinational companies, to review their transfer pricing activities, as for instance, maybe a number of transactions of these big multinational companies could be done with their companies, affiliated companies overseas. For example, they may buy goods from their headquarters located overseas and sell these goods subsequently in China. And these transactions can raise a number of issues in relation to transfer pricing and might attract the attention of authorities in order to ensure the full compliance of the transfer pricing policy. And that's all for today's presentation. Thank you for listening. If you have any more questions, feel free to leave them in the comments below or contact us at the addresses indicated in the description of this video. Thank you.